I'll begin the next topic with a question. What's the bottom line? It's net profit, right? Well, yes, that's the correct answer. But the question is wrong. It should be, what are the bottom lines? You see, net profit is only one of 4 bottom lines which indicate the true financial performance of a company. In fact, it's not even the most important of the 4. The 4 bottom lines that a business owner must fully understand and monitor are return on invested capital, net profit, operating cash flow, and profit per employee. Like all metrics, each of these has inherent limitations and weaknesses, but as a package they provide a complete view of bottom-line performance with which to evaluate the health of the business. Remember, all bottom lines are lagging indicators, measuring past performance. Past performance does not determine future success. However, understanding the variables for each of these metrics can help you make decisions that will move them in a positive direction. Let's take a look at each of these bottom lines. It would be a good idea to have page 11 of your review sheet in front of you as we go through this. Return on invested capital. If I had to pick the most important of the 4 bottom lines, this would probably be it. This measure demonstrates how successfully the business enterprise turns capital into profit. In other words, it measures how effectively the company uses its money. After all, the primary financial reason for a business to exist is to return profit to investors and lenders. To be considered a strong performer, a business must at least yield a return higher than its cost of capital. Look at the denominator of this formula. It is based on the balance sheet, but with net profit as the prime input of the numerator, this measure is equally affected by revenue and expenses. Return on invested capital is very useful when comparing the financial performance of different businesses, whether within or across industries. Every company generates different revenue, profit, and cash flow levels, but return on invested capital provides an equalizing measure of how effectively companies produce profit from a given base of resources. I mentioned earlier that each bottom line has inherent limitations. The limitations of return on invested capital include 1. It does not measure cash flow. 2. It can be easily manipulated by accounting methods. And 3. It is more difficult to measure than the other 3 bottom line measurements. Net profit. Here's the one you're all familiar with. Net profit measures the economic reality of a value proposition over time. In other words, is the customer willing to pay more for the product or service than it costs the business to produce and deliver it? If so, the business will generate a net profit. This metric is calculated by deducting all operating expenses from total revenue. This measure is commonly presented in actual dollars as well as percent of revenues. For instance, $50,000 in profit or 6.8% of revenue for the month. To fully understand net profit, review the accrual basis and matching principle from earlier in this course. The inherent limitations of net profit include 1. It does not reveal the real cash situation since it focuses on the promise and agreement part of a business transaction. And 2. It is an abstract measure because it comes from the income statement and can be manipulated with different accounting methods. Operating cash flow. As you know, cash flow for a business is like fuel for a vehicle. A business can operate for a while at a net loss, but it cannot operate one day without cash. Thus, it is imperative that you track operating cash flow, the amount of cash generated by business operations. This metric focuses on the cash settlement part of a transaction. Not included in operating cash flow are cash items related to capital investments, investors, or lenders. In general, operating cash flow should exceed net profit. However, net profit should ultimately be the largest component of operating cash flow. One exception would be in businesses in a continuous pattern of high growth where cash is needed to fund working capital, primarily accounts receivable and inventory. The inherent limitations of operating cash flow include 1. Since it focuses on the settlement part of a business transaction, it can be manipulated by varied accounting practices and management decisions, such as paying vendors late, holding customer checks for deposit at a later date, etc. 2. It can be manipulated and increased at the expense of profit, as in the practice of factoring receivables, selling receivables up front for a discount. Profit per employee. Profit per employee measures the returns on talent in addition to capital. In today's knowledge-based economy, measuring the financial performance of intangibles is more important than ever. Intangibles might include process knowledge, brands, customer bases, or any other form of intellectual capital, such as specialized knowledge and relationships. Large profits can be produced by creating intangibles, as we see in the proliferation of technology, service, and web-based businesses. These businesses require little investment in traditional capital, but large amounts of investment in people talent. Profit per employee provides a metric indicating a company's success in converting its raw talent into profits. It is calculated by dividing the net profit by the number of full-time equivalent employees engaged in the business operations. The inherent limitations of profit per employee, similar to those of its numerator, net profit, include 1. It does not reveal the real cash situation. 2. It is an abstract measure because it comes from the income statement and focuses on the promise and agreement part of a business transaction. And 3. It can be manipulated through management decisions to use part-time or contract staff in place of full-time employees. Determining the number of full-time equivalent employees is an exercise in estimation. So that's a brief overview of the 4 bottom lines. Are you tracking all 4 bottom lines in your business today? Effective financial management should take all 4 bottom lines into account. Start with a monthly scorecard that puts all 4 in view. A sample financial scorecard is